It is wild looking at the May 7th earnings batch. We have high-growth software platforms actively letting people go because AI is writing their code, while big consumer brands are damaging their own profit margins just to keep a hamburger affordable.
Right. We analyzed several of these reports from Cloudflare to McDonald's, and the core story is really about what these companies are willing to sacrifice right now. And I should note the overall earnings quality here was deeply uneven. We saw a lot of genuinely strong underlying operations masked by really distorted financial presentation.
Completely. The whole batch essentially splits into three distinct buckets. You have consumer giants subsidizing survival tier prices, infrastructure builders acquiring bad suppliers to fix physical delays, and software companies stepping away from human labor.
That software piece is a fascinating shift. Cloudflare grew revenue by 34%, but they still fired roughly a fifth of their staff.
Because bots now review 100% of their production code. And, it is the same pattern over at Airbnb. They are dropping layers of middle management since AI is writing a vast majority of their internal software and resolving customer queries completely natively.
It is a permanent structural change. It looks like a standard tech layoff on the income statement, but it is incredible operational leverage. They simply do not need to hire humans to scale anymore.
Yes, but then you look at physical retail and it's the exact opposite reality. McDonald's is taking on heavy costs instead of shedding them.
Because they have to. Their corporate-owned stores totally missed internal margin targets. Management intentionally decided to eat the labor and food costs to push out a $3 value menu.
It just proves the lower-tier consumer is tapped out. They cannot tolerate another price hike, so headquarters takes the hit directly to stop people from abandoning the brand.
Exactly. The top-line system sales looked okay, but that corporate margin squeeze tells you exactly how broken their pricing power is at the bottom end.
Which leads directly into that final piece, the hardware and infrastructure builders. They're essentially buying time to clear out their own physical bottlenecks. CoreWeave printed an operating margin of 1%, which sounds terrible on paper.
Well, it's deceptive because they booked a tremendous multi-billion-dollar backlog, but they have to pay for expensive data center real estate leases long before the servers actually arrive and generate revenue.
And Rocket Lab is taking that pain even further. They are deliberately hurting their own gross margins just to outright buy their slowest third-party suppliers.
Right, purely out of frustration to enforce their own timelines. They secure the physical delivery first and just let the financials take the hit today.
It's a sobering look at what scaling actually demands in this cycle. The deeper mechanics of these AI reorganizations and those infrastructure realities are mapped out in the individual company episodes.
We'll catch you on the next one.